Our next guest says with the Fed on pause, the market rally will roll on. So why is Wall Street's biggest bear sounding so bullish? Let's welcome back Chris Harvey, Wells Fargo Securities Head of Equity Strategy. Now, when we say biggest bear, year-end target is 26.65.
That is correct.
So why you keep saying the market's going to go higher?
So we set that price target in December. We set that price target because we thought the Fed made a mistake. The Fed came out and admitted they made a mistake. And so as we go forward, we pushed up our risk premium very, very high to our high end of our historic range. The Fed has said, okay, we're on hold. And similar to Karen is they may halt. All right, we might not see another hike again or anytime soon. That said, we have to bring that down. In addition to that, what's happened? We were going into, I would say, a sentiment recession. That all changed at the beginning of the year when the Fed did a 180. Why they did a 180, it's not clear to me, but they did a 180, and that's the most important thing. Then what happened is credit spreads started to come in. The fear of the yield curve inverting ended. And now if you listen to corporations, CEOs, they're all saying that things are good. Lastly, Donald Trump is slow walking trade and tariff into the back half of the year because that, in theory, is going to help him get reelected. That, in theory, is going to help global economies. And so what you're looking at, what you're seeing is much more improvement and underlying fundamentals that are relatively strong with lower interest rates.
Okay. You came out with a note today also going overweight semiconductors, which is maybe one of the most cyclical parts of the U.S. stock market. So all in all, you sound a lot more bullish than what 26.65 would seem to indicate. It's just a matter of time before you ratchet that higher. I mean, do you ultimately think that we end the year higher here?
So our price target is very formulaic. So we're going to put in interest rates. We're going to put in credit spreads. We're going to put in our risk premium. And if you think that interest rate, well, we know that interest rates have come down. We know that credit spreads have come down. We know the risk premium cannot go any higher. And we're at 166 on the S&P earnings. We're at the low end of the range. We're not going to lower that. So we put that all together. We're reviewing it. Likely it will go higher. But really, our biggest call has been, the biggest change for us has been moving from quality into value. And that's part of why we're upgrading semis at this point in time. We find a lot of value in the semi space. We've been overweight software. That's worked out very well. We're bringing that back down. And we think what you want to do is buy the things, and as we said last time we were on the show, you want to buy the things that have a lot of value, where expectations have come down, and where people aren't there just yet.
So, Chris, let's talk about semis, because you're not alone. You have very good company in terms of your whole view and how a lot of this stuff has changed. But semis have just rallied 25%. And there's nobody out there that's saying earnings are about to grow.
Right.
And there's nobody out there that's saying we're going to see an acceleration in the global economy in 2019.
Okay. So what we've seen, so we've been underweight semis for the last year and a half, almost 2 years. And if you look at semis over the last year, they have underperformed software and underperformed significantly. If you look at expectations have come down. And if we look at positioning, most of the long onlys are overweight. The consensus overweight is software. It's not semis. Yes, they've bounced, but a lot of other things have bounced too. And furthermore, we've been positive on cyclicals. Coming into this year, we've liked the capital goods space. That's ratcheted back up. We're just getting a little bit more cyclical exposure, and what we're trying to do is play that value trade.
So, Chris, I'm curious, the Fed has spoken a lot about price level targeting, maybe getting inflation above 2%. How does that factor into your analysis of the market? So
a lot of our clients, they're afraid that the Fed's going to hike again. And what we tell them, if they're going to hike again, what's the environment look like? Expectations, or if you look at inflation expectations, they have to be higher. If you look at the economy, that has to be higher. And to a certain degree, you might have to have trade and tariff maybe not resolved, but much further along. And so when they raise, it's likely the S&P will be at a higher level.
Chris, thank you. Good to see you. Chris Harvey at Wells Fargo.
Dig him.
Chris.
I don't dig the fact that he thinks the Fed was making a mistake. I think the mistake they're making is now, again, another show, another conversation.
Sure.
In terms of the SMH, Tim's made the point. The SMH has gone from 80-ish to 104.5, which is where it closed today. I mean, that's a pretty big move in a short period of time. It topped out this time last year around 114, so I wonder how much room is left to the upside. I think there's a chance you get there, but I think, a lot of these stocks have had tremendous moves in a short period of time, so I would worry about that.